Is it even possible to buy a property without using your own cash? I'm Sam Powell.
And I'm Joe Kraus, and we're the host of Property Pals Australia. And in this episode, we're discussing how to use things like equity to your advantage to buy more property and scale your property portfolio and wealth a little bit faster.
Yeah, we also discuss joint ventures, what they are, how to do them, who to do them with, and offer a few key examples, as we always do, as well as how you can joint venture with others to buy a property without using your own cash.
Yeah, and we also discuss private lending, which is another option that can be used to get yourself on the property ladder if you don't have capital for a deposit.
And we talk about things like put and call options. They're thing in the past. Are they coming forward in the future? Where you can secure a property today and pay for it later and extract value from it. That you don't technically own the property throughout that process. It's a pretty cool little trick there.
Yeah, and we also lastly discuss seller financing, what it is, how to do it, and also how you can rent to own a property, which is another interesting strategy that you could do with the right people.
Yeah, but before we get stuck in, as always, I wanted to tell you that this is not the only way that we can help you for free. We have our own How to Maximize Your Borrowing Capacity mini course on our website. So head to propertypals.au/resources and download this tool because it's really going to help you increase that cash flow and achieve a better ROI for your investment purposes.
Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jared, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. Yes, we're on. So we're finally recording. This episode has been a tricky one with technical difficulties, but we're finally ironing out those kinks. And we're going to talk about how to buy a property without using your own cash.
Yes, there's a few different strategies out there in the Australian property market. Some that you may know, some that you won't. But hey, let's talk about it. And if anything lights you up, let us know below through those comments in there, because we can dive deeper into each individual one. The best way to start with everything is to summarize it all and get your mind ticking.
Yeah, exactly. And some of these ways are more common. The ones we're going to mention, earlier in the pod are more common than some of the ones that's towards the end of the pod that are a little bit left of field, a little bit harder to do, less common because they're harder to do, and can be a little bit more risky, but can still be done, especially if you're in a place where you're just like, don't have too much cash, but I really want to get into this property market. And I guess we should also preface this that the easiest way to buy a property is typically when you have your own cash.
Yeah, it's like everything, right? So I talk about the risk-reward ratios in previous podcasts, and it's exactly the same here. So there's strategies which are a little bit more risky, but that propensity to have that greater reward or your return on investment is obviously greater. So listen on in, we'll touch base with each of them. But first up, let's go with the most common one, shall we?
Yeah, equity.
Equity, alrighty-o.
So what's equity? Let's give us a quick summary of equity, and then
Yeah, so equity is basically the difference between the property value and the loan you have over that property. So, example, you've got a $500,000 loan on a $1 million property. You have $500,000 in equity.
So people need to have a property to use equity, and that property needs to have grown in value over the amount of the loan size. So this isn't for everyone. This is for somebody that has one property or maybe multiple properties.
Yep, it could be investment or your principal place of residence. Everyone trained you to buy your principal place of residence first. There's different strategies around not doing that because we're
Rent investing, they call it.
Yeah, for investing. Have a look into it. It's a really strong strategy. But yeah, so
That's your strategy. That's my strategy.
equity is look, when you're pulling equity out, there's restrictions with banks. So even if your asset was worth $1 million and you had a $500,000 loan, generally they restrict you to an 80% loan to value ratio. So round numbers, if you had that $500,000 in equity, in reality, you'd probably be able to pull out $300,000 because then you're going up to that 80% loan to value ratio, which is 800 grand, 800 minus 500, 300. Yeah, 1 plus 1 is 2.
And you're not using your own cash to buy the property because you're rolling over that equity to use it as a deposit to purchase another property. One thing is that can happen when you do take equity out of another property is your level of finance will increase. So you will be paying a little bit more. You'll have a higher loan than you previously did, but it allows you to secure another property at the current market price before it grows. So it's a winning formula for a lot of people. Some people don't like to do it because they don't like to increase their debt levels. I totally get that. It depends on how you want to run your property portfolio and your strategy for growth, right?
Yeah, exactly. So with those the increased debt levels, the banks will obviously stress test you on your serviceability, and it is an exercise. Go through, do it. If you can justify that higher expense to pull that equity out, a classic calculation that I do with my cash flows for investors is if you're pulling equity out of your principal place residence, as an example, or another property, the purchase you're going to go through, you're actually doing 100% loan to value ratio because you're using total debt. You're getting debt on the property through the loan, and the equity you're pulling out is also going to be debt funded from your principal place residence or other property. And then you add on your stamp duties and your legals. So generally, that's an extra 5%, 5 to 6% of the purchasing costs, call them. So the loan to value ratio on this investment generally sits around 105 to 106% as a loan to value, as a debt component.
Because you're taking, say you take out 80k of equity, you're taking that 80k and putting that back into the finance. If you're taking 80k out of your PPR, the place of residence, then you are putting another 80k of debt on that principal place of residence by taking that 80k and using it to buy another property.
Yeah, and what that's doing is it's going to diversify your risk. You've now got 2 new properties. You've also got that income generation from the rental income. So, you run those cash flows and you can see that if you're running on a 6.2% interest rate, then what is the holding cost going to be on that property on that loan to value ratio? And then you can just go look, and it might sit around. I mean, you can for a 9% gross yield on a lot of properties, they're actually paying for themselves, and that's a strategy which we can do in this current Australian market. It's quite difficult with interest rates at that 6+% range, but there's always an investment there. But you just got to be mindful of don't just run around chasing cash flow because it's the capital growth that's going to help you continue to grow your portfolio as well. It's a good balance between the both, and everyone's circumstance is different, right? Like this is just general advice. Once again, disclaimer.
Yeah.
Other households have a higher income component. They might have a higher risk tolerance. So it's got to suit the individual at the end of the day.
Yeah, exactly. And sometimes, it's a bit more risk to get into the market, doing these, what we're talking about here, not using your own cash. It might be a little bit more risky for you to get into the market because you're not using your own cash, but you're also going to get a higher reward. And then eventually, as you grow your property portfolio and the more, assets you have and more value you have in your property portfolio, maybe you want to bring your debt levels down that way. There's a really good quote that I got from a mate of mine, Owen, who he got from his wealth creation mentor, who said, for wealth creation, we need concentration. For wealth preservation, we need diversification. And I thought that was a really good one to remember when, at the start of your deal, you're trying to grow wealth, just concentrate on like one thing or one asset until you start to build that up, and then you can diversify into other assets.
Yeah, I mean, I was having a session with a client yesterday actually, and the world's full of trickery. And people, when you actually get to that point where you've saved all that money, there's all these people trying to get that from you, giving you all these types of advice, and it's getting worse and worse these days because there's so many, I guess, clickbaity marketing campaigns that are really showing, oh, you can make money this way, you can make money this way, and I just pull back. I got pretty deep into that. I have been deep into that for the past 10 years of my life, and there's no get rich quick. Like, there's obviously people that do that, and they're the poster child for certain strategies, but there's a lot that goes into it, and that's what going into what Joe was saying, which is just pick a lane and just become proficient at it and know it. And if you don't understand it, don't invest in it. That's kind of what it is.
Yeah, and if you listen to this podcast, it sounds like you're going to be picking property. So like, just lean into it and get the right people on your team. There are people out there that are selling products that aren't as valuable, and you don't get the best ROI. And I was talking to somebody about this in the business sense. Is like, sometimes it's part of the initiation, right? Like, you learn to see who is a shark in that particular, like, say if you're looking at property, investing in property, you learn to see who's selling the courses and what they're selling you, and you might buy into some of them. I did that, right? You remember when I did that back in 2018, Sam? I went and bought a course and did a bunch of training with this guy who was a bit of a shady character, and I blew a bunch of money. Made some great friends, and I did a good investment out of it through the back of people that I made friends with. But that was part of my initiation. Getting into property is like learning like a strategy that was not right for me, and not going down that track and spending a bunch of money and chalking it up as a loss. So yeah, you do need to be careful with who you end up working with. But let's get back to the topic at hand here.
Well, that is topic at hand.
Yeah.
Let's sort of jump into that scenario, because that is a strategy which at the time, Joe got really educated on that fact and spent a lot of money. I mean, what's a lot of money, mate?
I think I spent like 15 grand. So it wasn't like a huge amount for me, especially at the time. I was, it wasn't a big loss, but it was, 15 grand can go towards, buyer's agent,
yeah. But then there's buyer's agents that aren't worth it.
Correct.
As well, mate.
Correct.
So,
definitely.
And that's the biggest thing I've got.
That's why we're here to share with our team with you guys.
So the strategy, and we're going to touch base on that this one
later,
but let's do it now. So it was all based around put and call options, right?
Yeah, put and call options, and the strategy was securing a property for a $1 option, $2 option, maybe $10, $100, whatever it is, but securing a property and having that option to exercise that option to purchase that property in like a 3 to 6 month period. So maybe there might be like a unit for sale for $300,000, and you say, hey, look, I'll give you $320,000 in 6 months' time if we agree to me exercising to purchase this for $320,000. And I have, in that 6 months' time, I have access to the property to do whatever I wish with it. And in that time, you go in and you renovate the property, that unit, and then you sell that unit. You get a contract of sale. So, maybe you renovate it, you put like 20 grand into it. So your price is $340, and then you maybe sell it for $380. And get a contract of sale for $380. And then you exercise your option. You buy it for $320, and you put 20 grand into it. So it's going to cost you $340. But then you're making $380, so the difference is
40 grand.
Yeah, 40 grand, and
less your stamps,
less a bunch of things. Yeah. So this is just an example.
Yeah.
You can do it with whatever figures would work for you. The reason it was really tough is because it's not the best way to go, in my opinion, for my investment strategy. Is it's really hard to find people that want to exercise that option, because not many people know what a put and call option is on a property. and it just seems risky to them when they own a property. Why would they do that? And so you really need to find people that are desperados, that are wanting to sell their property and they need money straight away, or not straight away, but they want a higher price and they want it, maybe in the future. It's really tricky to find those. And I spent a bunch of time calling agents and making a lot of relationships, building them out in one certain market, and found it quite tough because everybody, even the agents, were like, "Are you serious? Like, this isn't a thing. Not many people do this." A lot of agents had never really heard of it. So, yeah, it was a strategy that I paid a decent money to learn, and I just wasted a bunch of time. I wouldn't say it's a complete waste. I learned a lot in the process about property in other avenues, but that's one way that you can purchase property technically without your own cash and without needing to put your own cash into it. And it works really well if you can find somebody that's going to want to sell you a deal with a put and call option and you have no cash to inject into it other than maybe a little bit, 10, 20 grand for a reno, which is not enough for a full property deposit.
Well, you can get finance on renovations now too.
Exactly. So
buy now, pay later renovations.
Yeah.
Companies out there. But I mean, going back
but
to
the risk comes up there. Like the risk gets higher and higher as you stack that.
Yeah, and your profit requirement there is higher to pay all your interest holding costs. I think. And the strategy itself was quite prominent like years ago, and it's more suited to a suppressed market. And so the last, basically since 2012, probably the bottom of the Australian property market, 2012, 2013. It's just been on an upward tick. So people, it's not in their best interest to sell someone a property in 6 months, essentially, for maybe 10 or 20 grand extra. And then you're competing against other buyers. But in a really down market, say they've done nothing other than maybe drop for the past 3 years, people under stress and they know they want to just get rid of it. They've got no buyers on the property. And this is why asset selection is so important, is that if you've got an asset that no one wants to buy and you have to sell, it's just a bloodbath. People put and call option people like Jared back in the day, they're the sharks that are just swimming around just going, oh, cool, well, I've got the money. I'm happy to give it to you, but on my terms only.
Yeah.
And they're only doing it because they know they're going to make a margin out of it. So you're the poor sucker left there that's over leveraged themselves or got sold a dud asset by a trained real estate agent who's there to sell you on the dream, right? There's so much to it. So
maybe we talk about that in another ep as well. We say this every time about how to not be sold into purchasing an investment that you don't know what it is and if it's not right for your investment strategy. So that's put and call options. We were going to talk about that later in the pod. Because it is something that's not super common. But back to equity, is there anything else to cover in equity before we move on to the next one, Tim?
No, equity. You're not using your cash, right? You're using the value of the equity that's in your portfolio already. So it's a great way. Without using your cash, right? You kind of got to switch your mindset from. Do you go from a saver to a investor or a property owner, and then you're paying all your repayments to hold that asset. That asset is becoming a savings vehicle in a way because you're putting money into it to stay in it, but it's increasing in value over time. So you're essentially just using those savings, which is called equity, that mindset shift to make your next purchase. That's a really common way.
Yeah, and it's a really good way because what you're doing is when you start to think about this and start to use these types of strategies, what you're doing is you're really starting to slip into the shoes and become the person that is doing wealth creation. And what wealth creation really is looking at what assets you really have and making sure your money is in the best buckets or the best assets that are going to provide the best ROI. And how can you pull some from one bucket or one area to another area to purchase more assets? And it basically becomes a game of income and asset allocation where you're putting your money to work for you more so than you having to focus on just your time on your hourly rates at your job. You're then focusing your time on how do I put these, different pieces of piles of cash or piles of assets, or what's, the value of the assets grown, how do I reallocate, funds? This is what I was doing on the plane yesterday. A friend of ours, Parker, and I went to New Zealand, and I'm just sitting there on my phone, just like punching in numbers on my calculator, working at like how do I shift this here, or like how do I, like, what's my next move? And that I'm proud of myself for training myself to learn to think that way in terms of how do you allocate funds and put that to work in a better way. And that's a really cool way for you guys to start thinking on your wealth creation journey.
Yeah, it's a chess game, and each step, it can get you to the win, and the win is, I guess, freedom, time, freedom to choose what you want to do. Anyway, I'll get into the mindset side of our time, but so equity is a very common way. Another common way is joint venture projects. So that's basically using your, I guess, knowledge, your skill set with people that have the finances for it. So obviously it depends on where you're at. I mean, you can do joint ventures with family as well, where they're the financier and you're the person going around finding the deals, doing all of the legwork. So it's not your cash. Just
a really good point.
Disclaimer on that one, not disclaimer, just risk warning is just know who you're getting in bed with, and know the complexities of a deal and contract everything.
Have really good agreements set in place, have good verbal communication agreements, and then put them into writing and make sure everybody is above board with everybody. But I like the idea of JV deals. I was talking about doing a JV deal with somebody where they couldn't get borrowing capacity, but they had cash. And like, I want to invest, but like, where am I going to get my best ROI? Whereas I could take their cash, use that as a deposit, and I would then have the financing in my name or in a trust or under a company. So I'm not putting my own cash in, and they're fronting the deal with cash for the deposit and purchasing costs, and then I am holding onto the finance. It's under my name, but it's really, I'm not having to use too much cash if it's a positively geared property. I just take on the risk and of that loan, and then they take on the risk of the money being put into as a deposit. And if you've got a really good agreement, like maybe you hold it for 10 years and you split it up, then it's a huge win. So that's one type of JV deal that you can do. What's some of the others, Sam?
Professionals, like, so your skill set, right? You'll get a developer that's a classic example where they've got all the connections and they've got all the deals, but they get people to finance the deposit, and they're just equity partners in that sense, joint venture. So just look at your skill set. If you're a builder, you're a tradesman, and you can put that sweat equity, we call it, into the deal, or you're really good at finding asset deals. So that's a skill set in itself. You can use other means other than just cash to purchase property, but you just got to go in with your eyes wide open and have those partners essentially that are happy to do those deals.
So maybe like as an example, a tradesperson might know how to do a renovation or can do a renovation. Somebody might purchase that deal, they'll put the cash in, they will do the renovation and then agree to sale. And once they get to a sale price, then they split, the earnings between the extra growth of the property, I guess, between the tradesperson that does the work and then the person who finances it.
Yeah. So the joint ventures leads pretty closely into the private equity funding and lending, which is it's a third common strategy that we see. So you've got your joint ventures are they're more those like agreements where you're both joint working together to achieve the goal. Whereas your private lending and your family lending, it's more so you're the one doing all the work, and your financier basically. It's not a bank. It could be a bank, could be a third or fourth tier lender, loan shark, or those kinds of things.
So this is kind of a separate one, a different one in itself, right? Private lending, where you could actually get maybe somebody will just give you cash. Maybe you get like 80 grand cash for a deposit. $70 grand or $60 grand cash for a deposit from somebody, and you go away and agree to, you know,
You buy an asset.
yeah,
You
buy an
use
asset.
their money as a deposit, but it's all in your name, but you've got a private agreement with them.
Yeah. A caveat at the end of the sale of the deal, maybe in 5-10 years' time, that they take X amount and you take X amount at the sale.
Yeah. And there's also a great way, like a lot of big family fund managers, all the trust fund babies in the world, they don't need banks. They just use family, and they can have good loan agreements. And if you've got that much cash at the bank, from the family point of view, if you hit stressful times, your family's not going to fall in that loan unless they really have to. But yeah, to each their own. But the private lending side, it's different in that they're not doing anything other than giving you the ability with the cash that you need. Whereas a JV is a joint venture project is you're both doing the work towards the common goal. It just depends on. Like I've been approached with joint venture projects where I find the asset, I buy it, I do all the calculations on it essentially, and they just fund it. Yeah, and then also with their connections in that space, they help open doors for me in ways that I wouldn't be able to do it by myself. So
another way, I guess, for private lending is like for a deposit, you could get a loan for a deposit. Not advocating this at all, but you could get some finance for a deposit, purchase that property with that cash that you got as cash advance through finance, and then get finance in your own name to purchase the asset with that deposit. Yeah, and you got two sort of loans, but there's definitely risks with that as well.
Well, you got 106 or 105% debt on it, so you make sure the cash component that asset is giving you is going to be worth the squeeze, right? Like you're looking at a couple $100 a week in that case. How much you're earning, is it worth it? You don't want to stretch yourself out completely. Worst case scenario, put your hands up, declare bankrupt. Banks hate you because you repay your loan. You've got a 7-year black mark against your name, and the person who lent you the money at the start comes after you for 80 grand or whatever it is.
Or your legs,
depending on what part of the world you're in.
Yeah.
But yeah, they're your three main common ones anyway: equity, joint venture deals, and then private lending. So I'm talking friends, family, loan sharks, development finance, anyone who wants to give you money. And there's a lot of people out there that are happy to give you money for 10, 20%, because that's what they run a business off it. And yes, it's not a bad thing. It's just opportunistic. Like some people, they can't borrow money. They might have a really successful business, but they've been there for 12 months and banks aren't touching them. They've got to go that alternative route, and there's a good opportunity. So you just do your calculations and make sure it fits.
Yeah.
Go on.
So they're the pretty common ones. The less common ones that harder to do typically. They can be done. Yeah, these are the juicy ones. So we've gone through put and call options, which is pretty juicy, and then we can move on to seller financing.
What's seller financing?
What is seller financing? I put this one in here to chat about because when people buy a business, they can use seller financing, and buying a business can be similar to buying property, where you decide to purchase the business for a certain amount. Say you buy the property or the business for $500,000, and you say, hey, like I've got no cash, this is worth $400,000. I'll buy it for $500,000 or maybe $450,000 or whatever it is. And then the money that you earn through that investment, you pay out over time.
So using the seller,
the person
as the bank.
Yeah. Correct. Yeah. Then you pay them back over time. It's pretty typical with the business. It can be done with the property, depending on the property type. It's probably more common with commercial if you find the right person to do it with,
or family,
yeah. Or somebody that's got a good personal relationship and
happy to take the risk on.
Yeah, happy to take the risk on it and be the bank basically.
Yeah, like everything.
And the interest, say the interest rates at the bank might be 6%, with you getting your own finance, but you can't get finance. So maybe you say, hey, how about I give you 8% if you finance the deal? And they're like, cool, like they don't need the cash straight away, and they might be the bank, and you pay them 8% instead of 6% from the regular bank, and at least you can finance the property through them.
Yeah, but they'll. I mean, if they don't ask these questions, that's obviously a win. But they should be looking into your financial situation. So be open to opening the book to your financial position, because they're taking a risk on you, and obviously if they're open to seller financing, that's a fantastic result. So it's got to be a win-win scenario, like everything.
Yeah. And then the next one, we've got rent to own, which is kind of similar to seller financing, but it's without paying interest.
Yeah, yeah. So it's kind of, I mean,
it's like what you would call in buying a business an earn-out.
Well, it's like what the same name says in the name on the box.
Yeah.
Which is, you rent the property, you pay a slight premium, and you're essentially not only just paying the rent, but you're paying down, you're paying them extra money as the deposit, essentially, and then you get to that point where you've got enough in that deposit where you can go get a loan and finance it and say, I've got X equity built up in this property. It's all contractual, so speak to your conveyancer solicitor around how to structure that. But for those who are listening to this, they're on the renting ladder and they want to get into property, it's an option, right? Like, all you can do is ask the owner of the property if they're open to it. And I don't know, like, I'm seeing, like, I get really good vibes out there in the world, especially Australia. Like, people, they take lower purchase prices of properties because they want to sell their property to someone who is a good person who's going to look after their home. Like, it's
so normal.
It's doable, but you just got to know the questions to ask.
I actually have a segment in some of my training that I do when teaching people to buy businesses, and it's called How to Become an Attractive Buyer. Because the more attractive you are as a purchaser, typically the less you can pay for the deal because you're attractive. You're an attractive buyer, and the person who's selling their business, it might be their baby, or it's their home. It might be their home that they put a lot of love into. They want that to continue on. For example, I'm getting out of Australia, and I've been selling some stuff, and I sold this awesome guitar the other day for a lot less than I wanted to sell it for, just because I knew it was going to a good home. And same with any asset, really. It's like, if you learn how to build relationships with the broker and also maybe the seller if you can, then you can get deals cheaper.
Broker being sales agent.
Sales agent, correct, yeah.
We've got to keep doing this, man. I'm sure people that listen to us are like, oh yeah, Jared says broker means sales agent in a way. But the same.
Same, yeah. So that's rent to own. And then we've got an interesting one that you threw out there.
Yeah, so definitely depends on the time, the place, and who you're dealing with. There's asset swaps. So classic, and this is probably more for like the house and land package sales agents who just want to get that, that land sold, essentially. So people, and I've seen people do very well at this.
Yeah, so give us an example of
so asset swap, you have a car, your car's worth 30 grand. You don't need the car, you need the house, because you know that, hey, I'm at that stage, if I can use this car as my deposit, they'll take that as a deposit of $30,000. Then you get the land, you can do your build, and then you can hire a car in the interim, because your asset of a house and land is going to appreciate more in value than a car. So it's definitely not for everyone.
And public transport until you can buy another car, or
it depends how desperate you are. Or you give them the car, 30 grand, go buy a $5 grand car.
Yeah, like 25k there to put towards something.
Or you don't have to give them the car directly, but sell the car down. But depends on where you're exactly at. If you're in that pressure cooker environment, and the sales agents like, look, we'll take your car, go for it. Right?
Well, it's coming back.
Call me first, and I'll talk you through it.
Yeah, call. We'll chat to you about our coaching soon. But we're not advocating people to sell all of their things that they have.
No.
But when you start to put on your wealth creation hat and you start to think of somebody who does build wealth, then you're starting to think of, how much ROI am I getting from this thing that I've got? And if I sold it, what's the opportunity cost of me holding onto it versus selling it and putting it into another asset, like buying a piece of property? For example, there's people that have cars that are like 70 grand. right? And they could sell that car for 70 grand and put it towards a property that is maybe they sell it for 70 grand and then they put towards 60 grand towards a property deposit and buy a $10,000 car. And then they're putting that $60,000 into an asset that is an actual liability, because the car's a liability at the end of the day. It costs you rego, maintenance, insurance, petrol, all these things. It does give you some sort of ROI in terms of transport, maybe fun, and fulfillment if you love the car. But
you love taking those Instagram photos of your keys, your Mercedes-Benz keys, or your steering wheel. See those ones, like, I'm killing it. I got an Audi, and it's like, mate, that's what's wrong with the world. Sorry if I get him a little high horse, but the world's full of trickery. People are putting out there what isn't actual reality. Like, anyone can go and get a car loan and drive around like they think they're killing it, and then drive back to their parents' place and sleep there for the night, or go sleep in a rental. People are actually just getting so lost in materialistic things, because there's billions of dollars spent on marketing every year to convince you to buy things you don't need. That is the key killer of wealth creation, getting you out of this hamster wheel.
Yeah, is thinking about what's your opportunity cost of holding these liabilities and these things that aren't earning you, or keeping you, earning you an income, and then are also keeping you in your current financial position. Maybe that's working as well.
Yeah. Okay. Put your big rocks in the jar, right?
Yeah.
That's what I say. But yeah, there's some key factors that we talked about. So, like, asset swap, that's probably the last one. Very unknown and rare. I'm sure there's other ones, but we wanted to sort of sprinkle that little thought process going in your journey, because if you see there how people reach out, they're really keen to get on the property ladder. They're just not sure how to go about it, and there's a couple of ways that you can leverage it. But if you do have any questions, or you have even alternative strategies that you've seen as successful, please reach out. We'd love to get you on the pod and to just talk about ways that we can help our community financially grow and prosper.
Yeah, thanks for listening, guys.
See you in the next one.